Well, hi, folks. And I don't really see them in, but there we go. Attendees. Yeah. Hi, folks. Welcome to our webinar. We'll be getting started here in about 2 to 3 minutes. I see Anna and Christopher. Thanks for joining. We'll be starting here in just a minute. And Wendy, welcome as well. Once again, thanks for joining, everybody. We're going to be getting started here in about 2.5 minutes. We will not penalize those of you that were here on time. So we will start here in just 2 minutes. Almost ready to kick this off. Just 1 more minute, folks. Work on the stragglers here, and then we'll get started. Okay, let's dive right in. Folks, welcome to Mastering Financial Statements, our essential webinar series for small business owners. Today's webinar is Financial Statements 101. It's our 3rd session. We're going to be doing a deep dive into financial statements, understanding and analyzing sales, cost of sales, and gross profit. We're going to have our awesome presenter here, Anthony Foscolos, here in a minute. I'd like to introduce everybody to the Chief Revenue Officer at Ceteris, William Worthy. William, you say hello.
Yeah. Hey guys, good afternoon.
Awesome, William. Thanks. William, folks, William comes to us with 8+ years of experience at Ceteris. He's based in Charleston, South Carolina, and he really plays a crucial role in advancing Ceteris's mission to really empower business owners in today's competitive market. Those of you on the call that are Ceteris customers, you've likely spoken to William at some point or another here over the last few years. Our speaker today, folks, is Anthony Foscolos. You want to say hi, Anthony?
Good afternoon, everyone.
Anthony brings us 25 years of experience as CFO, CEO, COO, and CEO titles. achieving 30% year-over-year growth for well over a decade. Anthony works remotely, and he's currently helping small businesses scaling to mid-market levels by providing consulting services on a fractional basis. Anthony's services include KPI development, financial analysis, budgeting, internal process optimization, managing exits, some M&A work, and expanding international subsidiaries. Thanks, Tony. Look forward to the presentation. Mission here at Ceteris, folks, is to help small business owners meet their business objectives by providing timely, accurate monthly financial statements. Full stop. We're going to dig into those today. Before I get into the learning points, I just want to note on the bottom of your screen, there should be a Q&A button. If at any time during the webinar today you have a question, we'd love for you to type it in there, and at the end of the presentation, we'll go through some Q&A. So please feel free to ask any questions as we go along. Just type them into the box in there. So here's what we're going to go over today before I hand it off to Tony. Today's learning points. Number one, we're going to recap session 1 and 2. We're going to recap the income statement in different accounting methods. We're going to be defining smart revenue, categories to track your sales on your profit and loss. And we're going to be defining a smart cost of sales to track your costs related to the sales made in a given period. And finally, the power of understanding your monthly gross profit. That's a big point here that we'll finish up with. So without further ado, Mr. Foskalos, the floor is yours, and we are excited to hear what you have today.
Thank you, Salo. Thank you, William, and thank you all for joining us today. So let's continue this journey of our learning. Let's start off with the recap of sessions 1 and 2. We're recapping this, so we're building on these points that we've learned. I'm going to emphasize points that we've learned already so we can better understand and absorb the learning points of today. Basic financial statements, we're going to talk about that very quickly. Your accounting methods as well. We're going to talk about the cash, the accrual method, and the modified cash or the modified accrual method. And the reason why we're going to bring those up again is because in analyzing your revenue, your cost of sales, and your gross profit, the method of accounting that you're using can impact the results. All right, perfect. Let's begin. So recap of the basic financial statements. Okay, we have our balance sheet showing us what you own, also known as assets, what you owe, known as liability, and the difference, known as the equity. The income statement shows you how much money your business made. That's your revenue or your sales. How much is spent, which is your cost of sales, cost of goods sold, and your operating expense. And then the differences, which is your profit, and the statement of cash flow explaining how your business generated cash and how you spent the cash. Okay, why do these statements exist? Okay, these statements exist to give you owners real-time performance evaluation of your business, all right? That will assist you in accurately and rapidly making good decisions. And another reason why you do this is to maintain partner relationships and fulfill compliance requirements. So your partner relationships might be other owners, okay? Compliance requirements might be a master franchise, might be a master franchisor, could be your landlords, could be the IRS. Perfect. Cash method explained. As I said, we're going to go over this quickly here, but I'm going to kind of emphasize the points that are really important for today's learning session. All right. So this is a straightforward approach to recording financial transactions. It's really simple. Revenue is recognized when the money, cash, is received, not when the sale has occurred. Expenses are recognized when the money or cash is paid out, not when you incurred the expense. Inventory under the cash method is expensed when you pay it, not when it's purchased or when it's used to generate the sale. All right, what are the advantages of the cash method? Simple and cheap, okay? That's the advantage. Allowable by the IRS. This is good too, and it does explain what's going on with your cash well. What are the challenges with the cash basis? Okay, well, it doesn't paint a full or complete picture over the period. Now, the shorter the period that you're looking at, the more inaccurate it is. The longer the period you look at, it becomes more accurate. All right. So longer periods would be a year period, shorter periods would be a month period. Can mislead revenue, especially for businesses invoicing or reports, because a lot of it, again, is recognized when the money hits your bank account under a true cash basis. Can mislead your costs of sales and gross profits, especially for businesses selling inventory. Can misrepresent, okay, expenses because they are a function of what was paid, not what was owed, okay? And at the end of the day, it's just not proper accounting and can lead to confusing or lower business valuations as well. All right. So under the cash basis, okay, the profit and loss, okay, will show readers, okay, revenue again reported when it's paid, not when it's earned or when you've received it, okay? Variable costs and costs are reported again when paid, okay? Gross profit equals revenue less the cost of goods sold. We're going to deep dive into that today. But remember, on the cash basis, what you're really seeing is money in, money out for the cost of sales portion of it to come up with that. So it could be misleading, especially over month periods or quarter periods. Gross profit is a function of what you paid, not what you used to generate the sale. Your fixed business expenses, operating expenses in the lower half of the picture, okay, is reported on what was paid out. Okay, so if you just paid out your insurance for the whole year, it's going to show on that month. Okay, perfect. So your net profit equals your gross profit less your operating expenses. Accrual method explained. Well, this is the accurate approach to adhering for accounting, and it uses and follows things like the matching principle. The matching principle says, listen, if you record the revenue in this period, record the expenses related to in this period, regardless of when you paid it. Okay. So the key points, revenue reported when it's earned, okay, when goods and services are provided, not when they're paid, okay, or you've received the payment. Expenses reported to the period it was incurred, not when paid. Inventory is an asset. It doesn't even show up on your income statement until you've sold something, and the portion that you've sold now tracks its way over through cost of goods sold as an expense. So we're matching the revenue with the costs. Long-term assets are reported as an asset. So again, it's not hitting your income statement. It's depreciated over time, and over their useful time, we depreciate it. Again, we're matching. This is a 3-year benefit asset. We're going to depreciate it over 3 years. Perfect. All right. What are some of the advantages of this? Okay, advantages. Well, it's much more accurate representation of your financial picture. That's why we do it. Okay. Way higher comparability value, promotes much better decision making. Okay, promotes confidence to the users and better value when you sell or when you transfer the business. It's going to be worth more. All right, challenges. Okay, well, it's more complex and it requires more sophistication. Okay, it's more time consuming and it's a little higher cost. Okay, doesn't explain movements in cash the same way, but we have a statement of cash flows that does. All right, so the profit and loss. So under this, okay, it shows readers revenues reported when the sale is made. Okay, variable costs reported when the sale is made. This is the matching principle as we've talked about. In this case, now your gross profit really does represent your revenue less your cost of sales. Your gross profit is really a function of what was sold and what the direct costs were. So it's accurate and representative of your true gross profit. Your fixed business expense, operating expenses at the bottom half, okay, are now reported, okay, on a monthly basis as they are used and incurred, okay? So for example, if you're paying a lease deposit and a lease payment, your deposit's not showing up here and it's for what's being used for the period. Net profit equals gross profit less your operating expenses. Modified accrual method, modified cash is a mix of the two approaches. Key points. Look, typically revenue is reported when it's earned, not when it's received. Typical operating expenses tend to be reported when paid. Okay, inventories typically expense when used, not when purchased. So that's back to the accrual side. Assets typically depreciated over time. Payroll typically expensed when paid. All right, now this can vary depending on what's being used, but this is kind of standards for what a modified system looks like. Its advantage, it's more accurate than the cash basis alone. Much better comparability value to its own prior results. Now, the closer it is to the accrual method, the more accurate it's going to be. All right. Perfect. And this promotes better decision making. Remember, that's one of the purposes of these statements that you're getting every month is to analyze them and make better decisions. Great. Challenges with it. Well, slightly higher cost than a cash basis alone. Okay. Can be significantly different than the money in, money out results. But again, we have a statement of cash flows that shows us that. Now, it's not as accurate as the full accrual, so it still can misrepresent. It's not fully GAAP, but you're getting much closer. One of the biggest challenges is if one group of people is using a modified method this way and they're tracking their inventory correctly, the other one is expensing their inventory. Now you're comparing apples and oranges. So it makes it harder to compare along other organizations, okay? Or within the organization if there isn't a set defined template for all of them must do this, all right? Perfect. Okay, now we can get to the focus of today's sessions now that we've just kind of warmed up on refreshing ourselves on this. And we're going to define SMART revenue categories to understand your sales streams. Okay, SMART, specific, measurable, okay, attainable, realistic, timely, okay. Those are our concepts. We want to incorporate this into our financial statements so we can drive results.
Yeah. I'm sorry
Perfect.
to interrupt here, Tony, but folks, keep those questions coming. I'm seeing a handful of questions in there, so feel free to add them in there and we'll get to all of them at the end of the call.
Excellent. Love that. Thank you, Solo.
Yep.
Understanding your revenue. Okay. Your revenue, your sales drives your business growth. Okay. How you report your revenue on your monthly profit gives you the power to understand those streams and what their trends are, how they're moving. All right. So let's talk about the steps in understanding and analyzing your revenue successfully. First, define the stream. Okay. If you're not defining it, you can't measure it. Okay. So what do I mean by this? I've seen many organizations that report their sales on one line on their financials. Okay. So we don't have the optics on what is driving that revenue because all we have is one bucket, one stream, looking at top line revenue. Okay. Track them in your POS system and in the accounting system separate. There's a reason. If you're just relying on your POS system, we're going to talk about what the drawback is to them. Okay. Sure, it's going to give you an accurate number. Okay. But it's not going to tell you the costs associated with that revenue stream. Perfect. Review your monthly financial statements several ways. Super important. Okay. Identify positive and negative trends for action plans. And we're going to talk about the different ways to review your monthly statements different. All right. Let's define your revenue streams. Okay, perfect. We're going back to the fitness club. Define how you track different sales streams into different subcategories. So in this case, we have memberships, we got specialty classes, and we got product sales. So in this case, we got 3 buckets. All right. Your accountant designs this when they're building your chart of accounts by creating this. Now, your accountant designs this, but he doesn't necessarily understand what's important to you and what are you trying to drive. Okay. So you need to work collaboratively to do that. Does this sub-account have a different variable cost structure behind its sale? If it's significant as a revenue stream and it has a different cost structure, okay, I like to separately stream them. So in this case, membership revenue has a different cost structure behind it, the specialty classes. So that's a reason for me to bucket them differently. Another reason to bucket them differently is marketing and selling costs, if they can be directly related to a stream of your revenue. So for example, are you marketing your yoga classes? Fine. If you're going to go on a campaign to market your yoga classes, and what we want to know is how the yoga classes or the specialty classes reacted to that marketing so we can get a ROAS or return on ad spend for that incremental change and say, hey, this is working. Hey, we got a course correct. Perfect. Is this an important aspect in the long-term growth and sustainability of the valuation of the business? All right. So this is something people figure out, when they're trying to go to market. But at the end of the day, membership revenue is going to have a different value when you're going to sell your business than your product sales are. Okay. If you're generating half your revenue through product sales and half through your memberships, and the other fitness club is generating 90% of its revenue through memberships and 10% through product sales, there's going to be a different valuation. Okay. So that would be a reason to separate bucket. Do I want to understand how this stream is behaving over time? That's call for a bucket. Now, does it matter or is it material? To me, those are very important things. So I don't want to analyze a whole bunch of things that aren't there unless someone says, Tony, you got to use it this way. Okay. But what I'll typically do is I'll rank the most important ones at the top so I can rank the corresponding costs if they're different to them. Perfect. Analyzing your revenue. So now that we've talked about how you're going to structure your revenue, your chart of accounts, and your reports, let's talk about how we're going to compare how these behave over time. So comparing prior period results is super helpful. Okay, that's what we're doing in accounting. Unfortunately, we're looking in the rearview mirror, okay, and we're driving the car forward. That's what we're doing with traditional accounting. So how do we compare prior period results? The answer is we look at it a couple different ways. So I'm going to give you 3 comparisons that I like to help understand if my revenue is behaving right. And they're hard to generate from your POS system. You can, but you've consciously got to do it. And again, in your POS system, you're not going to get the related costs. All right, perfect. This month over last month. So November 2024 versus October 2024. That's this month over last month. All right, this month, year, okay. This month, this year to last month, last year. So in this case, we'd be talking about October 2024 compared to October 2023. That's super important if you're a seasonal business, because if you're a seasonal business, you're going to have some months where you're going negative and it has nothing to do with, are you doing a better job managing the company? It's just the seasonality of the business. So month over last year's month is really important in seasonal businesses. Okay, this month year to date compared to last month year to date. Okay, that's also one of my favorites because now it's telling me what's going on this year to this date versus a year ago, where were we? So when you start looking at your financial reports from 2 or 3 angles, you start to understand those trends, okay? Where are the opportunities? Where are the challenges? Perfect. So again, better analysis of understanding the successes, challenges, opportunities, and threats. All right, smart categories for your cost of sales. We did it for the revenue. Let's do it for the cost of sales because we want to determine our gross profit. Excellent. So cost of sales. Look, super important in understanding your cost of sales because it affects your company's profitability, your pricing strategy, your operational efficiency. Okay. How well are you operating is in your cost of sales and your gross profit and your revenue and your cash flow. All right, perfect. So understanding and managing cost of sales or cost of goods sold in businesses will improve their financial health, make more informed decisions that are better, and compete against the marketplace. Excellent. So let's talk about the buckets, okay? Now, in order to be in your cost of sales, it should follow the general logic that an incremental sale sees an incremental kick up in my cost of sales. Okay, so in this pharmacy example, we're seeing a great case of that, okay? So again, what we're seeing is pharmacy sales in the dark purple and pharmacy cost of goods sold in the dark circle. So now we've got a revenue driver and we have a cost driver. All right, perfect. Over-the-counter sales. Okay, we have a revenue driver. We have over-the-counter drug costs. Perfect. And then we have other kinds of revenues that may not have direct costs and other types of costs that may not have other revenue. So key considerations on defining your cost of sales sub-accounts. So we'll call that sub-accounts as well of your revenues, your pharmacy sales, your over-the-counter, the AR adjustments, okay? And on your costs, same thing. Does the sub-account have a different variable cost structure behind its sale? If it does, I usually want to group them out. All right, how material is the amount every month? Will it help me make better decisions? Look, I don't want to track something because I can't track it. I want to track it in isolation. Okay, I want to track it because it's going to help me make better decisions. Perfect. Is tracking this an important aspect in the long-term growth and sustainability of the business? Okay, start with the end in mind. Okay, do I want to compare this against a specific revenue stream over time? Great, we're going to talk about that in another minute. So let's talk about how you're going to analyze your costs of sales. Well, analyzing that our cost of sales is also done through comparisons. So I'm going to give you the 3 different comparison purposes again, okay? So now what you're doing is you're isolating and you're just focusing on those sub-accounts and the cost of goods sales on each of these 3 reports. This month over last month, this month this year to the same month last year, this month year to date compared to last year, year to date, trailing 12 months versus prior trailing 12 months. So a year ago's 12 month as well too. There's a lot of different ways to look at things. Monthly to analyze the trends. I'm just giving you a couple of the comparisons that I like to look at. Different comparison periods allow for better understanding and success challenges, those opportunities, and those threats. It also kind of lets you know where your costs are going. So let's just say you're operating a fast food business and you're tracking your food costs and your drink costs separately and so forth. Well, now you've got a nice good trend that you're really understanding how it's behaving against the sales. Typically what I'll do is I'll sometimes move those into spreadsheets as well. Okay, and we'll talk about what we'll do inside those in a second, because now that we've got our revenue broken out in streams, so we've got our cost of sales broken out in streams, let's talk about the gross profit analysis, okay, and measuring the operational efficiency. All right, measuring gross profit. Okay, I would say that this is probably number 2 or number 3 most important line on your statement, okay? Sometimes I'll say it's even ahead of revenue, okay? If I see the improvement in gross profit month over month, okay, I'll take that over revenues went flatline, and I'll say it was a successful one, okay? Gross profit is really important because in gross profit, whatever extra money you've made there, if your fixed costs are the same, it all spills into the profit at the bottom line. Okay? So measuring gross profit, keeping your eye on gross profit, really important. So we measure gross profit to understand operational efficiency, pricing effectiveness, and to manage those direct costs. Okay. When we measure gross profit, we measure and understand how changes in sales impact our profitability. So you remember, we've got 2 variables that we're comparing: changes in sales, changes in cost of sales, and then they're fleshing out in the gross profit. So it's a moving target what's going on here, okay? With gross profit, so we want to analyze what impact does our sales, what impact does our direct costs have on gross profitability, and then how are those combined forces acting on our gross profit. Okay, this also allows us to determine something called your gross margin. Okay, we'll talk about your gross margin a bit more in a second, but gross profit is the key aspect, okay, of your profit and loss. Analyze it every month. Okay, analyze it and try to understand why it's changed. Where are those changes specifically coming from that are driving those changes in gross profit? You understand that, you're on the key to growing. Perfect. Analyzing gross profit. Let's carry on. So analyze gross profit by revenue stream when possible. Okay, so this is a little sidebar. Okay, so when you got your financial statements prepared, we have one line at the bottom which says our gross profit, okay, for the period. In this case, it's $212,000. But when I'm talking about analyzing gross profit by revenue stream, I'm saying look at your pharmacy sales, look at your pharmacy cost of goods sold. What we find there is it's around a 24% cost, giving us, okay, giving us around a 76% gross profit. Well, what does that all mean? That means if there's $1 more in pharmacy sales, I can expect to see 75 cents hit the bottom line. Okay, over-the-counter sales on the other hand. Okay, that had $7,000 of revenue in the medium purple, and it had $3,000 of cost. So that's around a 40% cost of sales on that revenue stream. So what does that mean? Now, $1 extra of OTC sales will now generate 60 cents, okay, on the gross profit. So as a person who likes to optimize business performance, what do I like to see? Well, I like to see more pharmacy sales whenever possible. I'll take $1 pharmacy sales over $1 on the OTC sales, okay? Does it also mean that my OTC sales, okay, are starting to climb up more year over year? Is that another issue? See, because, you know, last year was, you know, it was 50%. We had $4,800 of revenue from January 23, okay, to September 23. We had $4,800. and we had $2,400 cost. So it's actually, it's moving in the right direction. It's getting better, but it's still not as good as the pharmacy sales. All of this analysis provides insight to determine which streams should be emphasized. When you understand your margins by revenue stream, you know where to step on the gas, as I call it. Okay, stepping on the gas could include more marketing efforts. Okay, this provides focus on corrective actions. It gives you an indication of, do we need to move our prices? Do we need to find better suppliers? Okay, all of these things done, but what we're trying to do is we're trying to analyze all of the inputs that are generating the revenue, not just the total revenue, all of the inputs to the cost of sales, relating each of those revenue inputs to each of those cost inputs, and analyzing each independently to figure out how we can make more money. Okay, perfect. Analyze gross profit margins as a whole by comparing movements month over month. Okay, so we need to analyze how these things are moving month over month to see if we're winning at the gross profit level or not. Gross profit success is super important. You'll find banks are very focused on that as well. Okay, so are other potential owners or investors. Okay, movements year to date over prior year to date, movements last month over last year, the same month, and identify those changes line by line. All right, identify corrective actions, okay, such as increasing your prices on various streams, reducing costs as we've talked about, and let's do it. All right, beautiful part of this. We have gross profit versus gross margin. Okay, what's the difference? Gross profit is the dollar amount remaining after subtracting the costs of goods sold. So when we're talking about gross profit, we're talking about dollars. Okay, conversely, when we're talking about gross margin, this is the percentage of revenue that exceeds the cost of goods sold. This is a percentage, okay? And as I mentioned, I like to understand my gross margins by product lines when I can, okay? So that was the important takeaway. Again, let me just summarize a little bit of the session here. Let me tell you why both of these are important as well, too. So gross profit helps businesses understand absolute money that they're making from their sales, okay? The absolute dollars are absolutely important, but the efficiency of that incremental sale is also something we need to be conscious about. That's what gross margin does. It provides that insight into the efficiency, okay, of a company producing its goods relative to its revenue. It's a key indicator of the profitability that allows for an easy comparison across companies that are different size. Now you know how you're doing against your peers, how you're doing against yourself. Okay. So again, just to recap, okay, some of the important points of today's session. First of all, choosing how you are reporting on your financial statements, cash, accrual, modified accrual, okay, is really important in understanding the limitations when you're analyzing a number. Why? Simple. If you're reporting on the cash basis and you had a strong sales month, what people tend to do is pay more bills when they have. So if they have a backlog of bills, they're going to pay those bills. Now, whether they related to the increased sales or not, they're going to catch up on their bills. And now suddenly you're catching up on your bills, okay? And as you're catching up on your bills, your gross profit is being eroded because your gross profit is really a function of what you paid, okay? So choosing your accounting method, okay, when you're trying to analyze your performance has a very big impact. Now, the shorter period of time you're analyzing, okay, versus a longer period, the more that will be exaggerated. If you were comparing a cash basis for 12 months to an accrual for 12 months versus cash for 12 and accrual for 12, you get closer to the mark. You're still going to be better under the accrual, but you're closer. But when you're looking at month over month, those changes are really hard on a pure cash basis. All right, so understand your accounting method treatment, how it's going to impact your numbers. All right, once you've done that, segregate your revenue streams by what is important for you and what has a different cost structure, okay? Then, as you're doing this, pull lots of different reports. Look at those reports in isolation. Don't look at them all at once. Look at revenue and compare revenue on 3 different reports. Compare costs on 3 different reports. compare gross profits on those different reports, and understand your trends. Okay, what's working, what's not working, what are your corrective actions? All right. When possible, try to figure out what your gross profit and your gross margin is by product stream, so you know what to do on a product by product basis or a service by service basis. Excellent. Well, thank you all for making it this long. Solo, you mentioned we may have a few questions in queue. I'm looking forward to hearing them.
Here we go. Okay. So Shalise and Chris had some questions about the recording. I think those were answered. If not clear there, please let us know. And we have some other questions here. Question from Sherry. Where would you put your marketing costs?
Yeah, perfect. Great question, Sherry. So where do I put my marketing costs? Long story short is this. Okay, I tend to like my marketing costs to focus more on my higher margin items. Okay, so for example, if we are selling, let's use Burger King as an example. Okay, you'll see commercials for the Whopper. Okay, now the Whopper might be a loss leader that they're also kind of marketing behind, but my bet is that the margins on their Whopper are also very high. So that will cause and create a marketing strategy around a certain segment that you are selling. In the fitness case example, is perfect. Okay, so the memberships, okay. So if the memberships have a higher margin than the classes, then I would go ahead and spend more money on the memberships. However, if the classes brought in new blood that eventually churned into membership, I'd want to keep that as a consideration as well. So the answer is use your numbers, use your mind, and then say, know what you're going to spend and what results you want from your spend before you spend it. Okay. So if you're going to go on $1,000 campaign, know that you want $3,000 more revenue or $2,000 more revenue as a result of that. Then you know your ROAS, which is 50%. Okay, now you still got your other costs associated, but at least you know what that is. Now, if you're getting extra membership sales, that's an added benefit. Perfect. Hope that clarifies that.
Thanks, Tony. Next question here. When is the best time to switch accounting methods?
Best time is usually January. Okay, that's the best time. Second best time is quarter ends. Okay, but typically, contemplate it, get ready, and then if you do a hard cut over January 1, I find that is the most convenient time.
Okay, excellent. Thank you. Next question. If I am currently using the cash method, how does that affect comparing revenue and cost results?
Yeah, perfect. So maybe I'll just give an example to clarify it. Okay. Let's say that let's go back to our gym. Okay. Back to our gym. Let's say that you charge for 3 months worth of sessions, okay, for the yoga classes, all up front. Under the cash basis, now you're reporting your revenue and it's going to recognize it when you've received the money, okay? But when you think about the costs of the instructor, that's going to happen every month for 3 months, okay? So here, for an example, is a great case where your cash basis, when you're trying to analyze your gross profits, you're going to get a mixed story, okay, because of the timing difference. Now, if you're analyzing it over a year, okay, that timing difference now just got swallowed up, so it's not so bad case. Good.
Awesome. Next question. If my payroll costs are being classified as an operating expense, can I break that out into our cost of sales? And if so, how does that happen?
Yeah, perfect. Great question. So a lot of companies will kind of put all their payroll on one line as an operating expense. Okay, if certain people, so let's just say the instructors for the yoga classes are all in that lower level. What I'll do is instead of kind of one entry kind of recognizing all the payroll, okay, I would ask, whoever is doing the accounting to see about how difficult it is. And usually it's not too difficult. Usually it's a little extra time, but it's not too difficult. See about kind of breaking out, some of the components, let's say the trainer's wages, and to put that into cost of goods sold. Okay. Now, the people at the front desk are kind of going to be there regardless of how busy you are. So to me, that deserves to be in an operating side. The people cleaning the facility, let's just say they're on payroll, same kind of story. Regardless of your sales, that's not really going to change. You need to spend the minimum amount to have it cleaned every day. So variable sales, I like to put salespeople's commission sometimes towards selling things that can sometimes break into as a variable cost as well too. Okay, good question. So at the end of the day, by defining your buckets and pushing certain costs into those buckets, we get better clarity.
Thanks, Tony. William, this one might be for you. I am using Ceteris. Am I on the accrual method already, or is that something that I need to request?
Yeah, typically today we're operating on a modified cash or accrual basis. So whoever that individual is, certainly reach out to me. I'll post my email address here, and we can take a look. But yes, we're accruing, most of the normal accruals every month today for you. But certainly can look at doing more of a full accrual analysis.
Gotcha. Thanks, William.
Yep.
Okay. Folks, that is our questions for the day. Tony, if you could move that slide one forward.
Yes.
I wanted to note William's contact information there for anybody on the call. William W. at ceteris.com, 864-316-5275 if you want to reach out to him direct. Please be on the lookout for our next webinar in this great series. That'll be coming your way. We'll have some invites out next week, and we're going to be on here for about another minute in case anybody has any other questions.
Perfect. And just some quick comments as well too. Everyone, if you're getting value on this, please share this with your friends and colleagues and other people who might be in similar businesses who want to understand things a little more in depth. This is a nice service Ceteris is providing, and feel free to use it. In regards to William's questions as well too, what I'll find is sometimes a main franchise group may want a specific path for all of the franchisees so they can compare as well too. For individual businesses, there's also a lot of flexibility, and I think to reaching out to William and having him go over that with you is a perfect idea.
Okay, folks. Well, thank you very much. Have a great rest of your day. Happy holidays and Thanksgiving to everybody. And we look forward to seeing you again in our next webinar. Thank you very much.
Goodbye, all.